Private sector economists have cut their forecast for Singapore's growth. They now expect the economy to expand by 1.4% this year. Now, this is lower than the previous estimate of 1.9% in March. And it comes on the back of slower than expected growth in the first quarter and risks of a global slowdown. Rebecca Mateo with this report.
Manufacturing is one of the biggest drivers of Singapore's economy, but the latest survey of professional forecasters by the Monetary Authority of Singapore indicates that the sector is set to shrink 1.3% on year.
The manufacturing sector had been around 20 to 30% above pre-pandemic levels and currently has been moderating in lieu of the global shift away from goods demand towards services. So I think as a result, there is some chance that the growth numbers this year is not very high because of prior growth and high base effects.
Non-oil domestic exports are also expected to deepen their slump, but on the positive side, the accommodation and food services sector is expected to grow by 10%, up from the previous forecast of 8.4%. The biggest improvement is expected in construction, growing by 7% compared to 4.2% previously. Meanwhile, inflation forecasts remain relatively unchanged. Core inflation, which excludes accommodation and private transport costs, is expected to come in at 4.1% this year, easing to 3% next year. Still, one analyst warns that climate change could increase the risk of higher inflation ahead.
The overall poor conditions would mean poor harvest conditions, and this constitutes to possibly higher agricultural prices, in the immediate term, and this gives the risk, of higher food inflation into Singapore's, onshore prices.
The survey also flags an external growth slowdown and geopolitical tensions as downside risks to domestic growth. On the flip side, more robust economic growth in China could boost Singapore's growth outlook, but analysts say this will take time.
I think the good news is that perhaps the authorities in China are also looking to perhaps put up more stimulus to help to support the economy. So when that happens, I think there could be more demand in China that could also help to benefit Singapore.
And also from the fact that rates are likely to be at its peak, especially from the developed economy's point of view, and this would mean that if there is going to be any pricing in of rate cuts into the middle half of this year, this will also be optimistic and beneficial for the global economy as a whole.
The forecast for GDP growth remains at 2.5% for next year.